Hi, and welcome back to Heimler's History Economics Edition. In the last video, we talked about banks and how they create money. And here in America, all the little baby banks that you see in your community actually have a big old daddy bank, and that's called the Federal Reserve. And in this video, we're going to look at what the Fed is and what it does. Let's get to it. So let's begin with some history. Where did the Federal Reserve come from? I mean, it's not in the Constitution, so why do we have it? Well, back in 1907, things went very bad for banks. I'll leave all the details out, but all you really need to know is that a few bank-like entities called trusts got a little reckless and ended up losing metric buttloads of money. And when all their depositors heard rumors about the loss, they rushed to the trust to withdraw their money and found that it was gone. And that doesn't sound like a big deal, so one trust went under. Well, when rumors started spreading that this one trust failed, more and more people got twitchy and decided to go get their money out of the banks too. And if you'll recall, banks don't keep all the money that is deposited in them, they loan most of it out. So as the hordes of people descended upon the banks and the trust to withdraw their money, they were only able to recover a little, if any of it, and that led to the Panic of 1907. Now, as it happened, a wealthy oil tycoon by the name of John D. Rockefeller, along with a few other wealthy people and the U.S. Treasury Secretary, ponied up a bunch of cash and gave it to banks so that the people who wanted their money could get it. And once people were relatively assured that they could get their money if they wanted it, the panic died down. But even so, the Panic of 1907 resulted in a 4-year deep economic recession that led to 8% unemployment. So the Panic of 1907 convinced policymakers that a more centralized banking system was necessary, and so in 1913, the Federal Reserve System was born. Its role was to compel banks by federal force to hold on to adequate reserves for its depositors. Additionally, it provided oversight to banks to assure that they would not continue engaging in such risky behavior. And finally, the Federal Reserve was endowed with the sole right to issue currency in our economy. Now, the structure of the Fed is a little bit difficult to classify. It's not quite a government entity and it's not quite a private entity. But it basically has two components that you need to know about: the Board of Directors and the 12 regional Federal Reserve banks. The Board of Governors has 7 presidentially appointed members that must be approved by the Senate. Now, the members of this board serve for 14-year terms, and all of this is so that the board is technically insulated from political pressure to influence monetary policy in one direction or the other. And as of this recording, the current chair of the Fed is Jerome Powell. Hey, Jerome. And then there are the 12 regional Federal Reserve banks. And here's a map to show you where they are in the regions where they serve. Now, one of the major jobs of these regional banks is to keep tabs on private banks to make sure that they're complying with federal standards and not being stupid. And the chief stupidity the Fed seeks to regulate is that banks hold on to a reasonable amount of its deposits. Now, despite all this federal regulation that came into being in 1913, bank failure was still possible because banks still had the option of loaning out most of their funds. And the nation discovered this quite devastatingly in October of 1929. In that month, the stock market crashed and people made runs on banks to withdraw their money. Even with the federal regulations in place, banks failed because they couldn't meet the demands of depositors, and we got ourselves into the Great Depression. So Franklin Delano Roosevelt, who happened to be president during this time, decided to remedy this problem and establish the FDIC, or the Federal Deposit Insurance Corporation. And the FDIC was there to insure people's deposits, so that if people put money into the bank up to $2,500, they could be assured that the federal government had their back. If the bank couldn't meet the depositors' demands for money, then the federal government would step in and give them their deposits. And I'm sure after that, we're never going to get into a crisis like that again. But by 1980, most people had lost the memory of all those bleak banking days of the past, and all the legislation that was passed to prevent such crises had really lost its teeth. So in the late 70s and early 80s, lending institutions called savings and loans, which existed to take deposits and turn them into mortgage loans for home buyers, began engaging in risky real estate lending, and long story short, a large number of these savings and loans failed. But that's okay, right? Because now we got the Federal Reserve to bail them out. Except when all those savings and loans failed, those debts became the debts of the federal government. And as you know, Big Daddy Government does not have a job. You see, the reason why Big Daddy Government can remain in the lifestyle to which he has become accustomed is because we humble taxpayers send him our monthly payments. So as it turns out, the savings and loan failures of the 1980s cost the American taxpayers about $124 billion. But I'm sure that we learned our lesson after the 1980s. I mean, after 1907 and then the 1930s and then the 1980s, there's no way the financial system could fail like that again. Wouldn't that be hilarious if we were like that? If you were alive in 2008, you know in fact we did not learn our lesson. So from about 2001 to 2003, the American economy was in recession, and we went ahead during that recovery and planted the seeds for a new economic crisis. In 2003, the Fed set the interest rates at historically low levels, and that led to a boom in the housing market. And as the housing market boomed, financial institutions began again engaging in risky behavior, this time subprime lending. Now, I don't mean to be a fundamentalist, but usually the way the world works is that if somebody can't afford a thing, they can't get it. I mean, if a guy walks into a jewelry store off the street and says, "Hey, I want that Rolex," and the owner says, can you afford it? And the guy says, no, I live in a cardboard box in the street outside your store. Can't afford it? All things being equal, the owner is not going to sell that watch to that man. And in general, banks loan out mortgages in amounts that people can safely repay given their current amount of income. But since the housing market was growing at an incredible pace and property values continued to rise, banks and investors started loaning out mortgages to people who could in no way afford it based on their current income, but they did so because they thought, well, property values are rising, and if they default on their loan, we'll just sell the house and make up the difference. And so, for several years in the early 2000s, the guy from the street walks into the jewelry store, asks if he can buy the watch, and then when the owner says, can you afford it, and the guy says no, the owner says, alright, I'll take a risk that you can afford it. Just make sure you pay me back later. But wouldn't you know it, that growing bubble eventually burst and property values started declining and people began defaulting on their loans wholesale and could not repay their mortgages. And as a result, the economy went into a deep, years-long recession. And so now I'm sure that we and the Fed and the banks have learned our lessons, and this will never happen again.
You're so crazy.
Okay, so that's what the Federal Reserve is. Now let's talk about what the Federal Reserve does. There are basically four functions of the Federal Reserve. First, the Fed provides financial services to depository institutions, which is to say that the Fed is the banker's bank. If you want to make a financial transaction, you just go down to your local bank. If your bank wants to do the same thing, then they go to the Fed. So the Federal Reserve holds reserves, clears checks, provides cash, and transfers funds to banks. Second, the Fed supervises and regulates banking institutions, which basically means it's a watchdog over all our nation's private banks to make sure they're not engaging in overly risky behavior. Third, the Fed maintains the stability of the financial system. Basically, this just means that the Fed is responsible for providing liquidity to banks and to provide for their flourishing. And fourth, the Fed conducts monetary policy. And since this is the most important of the Fed's responsibilities, we're going to spend some time here. Basically, in order to conduct monetary policy, which is essentially the Fed's decisions about how much money is in the economy, the Federal Reserve has three tools at its disposal: reserve requirements, the discount rate, and open market operations. Let's begin with the reserve requirement. The reserve requirement just says how much money banks are required to hold on to so that if you go to the bank and demand your money back, they at least have some on hand. Banks are required to hold on to some of their reserve cash. So if the Fed decides that the reserve requirement is 10%, that means that banks, when they get a deposit, have to hold on to 10% of that but can loan the other 90% out. So if the Fed wants more money in the economy, then they can lower the reserve requirement, say to 5%, and that means that banks have to hold on to only 5% of their deposits and they can loan 95% out. And vice versa, if the Fed wants less money in the economy, they can raise the reserve requirement. Next, the Fed can use the discount rate to steer monetary policy. So what happens in the case when a bank doesn't have enough funds to meet the reserve requirement? Well, in that case, they can borrow money from the Fed to replenish their supply. And the discount rate is the rate at which the Fed makes those loans to other banks. And usually the interest rate is a little bit higher than the normal interest rate to discourage banks from doing this kind of thing. So the higher the discount rate, the less likely banks are to borrow money. But the lower the discount rate, the more likely banks are to borrow money from the Fed. And finally, the tool that they most often use to steer monetary policy is open market operations. So in a previous video, I told you about government bonds. These are like short-term IOUs that the government sells to commercial banks so that they can raise money to pay its bills. So if the Fed wanted to increase the money supply in our economy, they would facilitate the buying of bonds. Because when they buy bonds, they're putting money into circulation and taking bonds out of the economy. And if the Fed wanted to decrease the money supply, all they would need to do is sell bonds. And the reason why that decreases the money supply is because now bonds are in the hands of investors instead of money. And that, ladies and gentlemen, is what the Federal Reserve is and what the Federal Reserve does. I will see you next time. Alright, thanks for watching another economics video. Now I, unlike the Fed, don't have the tools to increase the circulation of this video except to ask you to like it if you indeed liked it. And if you click that little like button, the circulation will increase. If you want to see more videos like this and more videos covering all things US history, world history, government, and beyond, then subscribe and come along.